Blockchain is, well, a special kind of digital notebook. Imagine, just for a second, a notebook that's shared among many people. When someone adds a new page, or what we call a block, everyone gets a copy of it. This new page is linked to the previous page using a special code, creating what's known as a chain. This setup makes it really tough to change or remove a page without everyone else noticing. It's like a chain of information that's locked together securely. This technology forms the foundation for cryptocurrencies like Bitcoin and Ethereum, but honestly, its use goes way beyond just digital money. It creates a system based on trust that doesn't need a central authority to manage it. Think of it like a public record book that's incredibly secure. Each transaction is a new entry in the book. Before a new entry can be added, a network of computers has to agree that it's valid. Once it's in, the entry is permanent and transparent. Anyone on the network can see the history of transactions, but, the identities of the people involved are usually protected by pseudonyms. This mix of transparency and security is really what makes blockchain so powerful. It removes the need for a middleman, like a bank or a government, to verify everything, because the network itself does the verification job. The key idea behind blockchain is decentralization. Instead of one person or one company controlling the notebook, power is distributed among all the participants. This means no single entity can shut it down, tamper with the records, or change the rules on their own. Each block of information is cryptographically sealed, making the entire chain of blocks incredibly difficult to hack. If someone tried to alter a block, they'd have to alter every single block that came after it on thousands of computers at the same time, which is, well, practically impossible. This distributed nature is what gives the system its strength and resilience. This technology provides a new way to build trust in a digital world. In our traditional systems, we trust institutions like banks to keep our money safe and our records accurate. Blockchain offers a different model where trust is built into the technology itself. The rules are written in code and enforced by the network. This opens up possibilities for creating more open, fair, and accessible systems for everything from voting to managing supply chains. It's a fundamental shift in how we think about recording and sharing information, putting power back into the hands of the users instead of a central gatekeeper. Decentralized finance, or DeFi, uses blockchain technology to build a new kind of financial system. It takes the traditional services offered by banks, like lending, borrowing, and trading, and basically rebuilds them on a blockchain, most commonly the Ethereum blockchain. This means you can do these financial activities without needing a bank or any other financial institution as a middleman. DeFi applications are open to anyone with an internet connection and a crypto wallet. The rules are written in code called smart contracts, which automatically execute transactions when certain conditions are met, making the process transparent and often more efficient. So how does this actually work in practice? Well, let's take lending as an example. In DeFi, you can lend your cryptocurrency to others and earn interest on it, just like a savings account. On the other side, you can borrow cryptocurrency by putting up your own crypto as collateral. Platforms like Aave or Compound are basically automated lending pools. Users deposit their assets into these pools, and borrowers can take loans from them. The interest rates are determined automatically by supply and demand within the pool. This all happens peer-to-peer, with the smart contract acting as the trustworthy intermediary that handles everything. Another popular use of DeFi is trading on decentralized exchanges, often called DEX. On a DEX like Uniswap, you can trade one type of cryptocurrency for another directly from your personal wallet. There's no central company holding your funds or controlling the order book. Instead, trades are executed against pools of tokens supplied by other users. These users, known as liquidity providers, earn fees for contributing their assets to the pool. This creates a system where anyone can participate in market making, a role that's usually reserved for large financial institutions, making financial markets more accessible to everyone. The core principle of DeFi is to create an open and permissionless financial world. You don't need to fill out an application or get approval from a bank manager to use these services. As long as you have some crypto assets, you can start participating right away. This removes a lot of the barriers that exist in traditional finance, especially for people in parts of the world with less developed banking infrastructure. DeFi aims to build a global financial system that isn't controlled by any single country or corporation, but is instead open for all to use and build upon. One of the biggest benefits of DeFi is the control it gives you over your own money. In the traditional banking system, you give your money to a bank and they hold it for you. With DeFi, your assets stay in your personal crypto wallet. You have full custody and control, which basically means you are your own bank. This concept is often called self-custody. You can move your funds, trade them, or lend them out whenever you want, without asking for permission or waiting for business hours. This level of autonomy is a powerful draw for a lot of people who want more direct control over their financial lives. Another major advantage is accessibility. Traditional finance can exclude many people. You might need a lot of paperwork, a good credit score, or even to live in a certain country just to open a bank account or get a loan. DeFi, on the other hand, is generally open to anyone, anywhere in the world. All you need is a smartphone and an internet connection. This creates financial opportunities for the unbanked and underbanked populations, giving them access to services like savings, loans, and investments that were previously out of reach. It really has the potential to create a more inclusive global economy. Transparency is also a key feature that attracts people to DeFi. Because most DeFi applications are built on public blockchains like Ethereum, all transactions are recorded and visible to anyone. You can audit the code of the smart contracts yourself to see exactly how the system works. This is very different from traditional finance, where a lot of operations happen behind closed doors. This radical transparency helps build trust, as users can verify for themselves that the system is operating fairly and according to the rules. It reduces the need to trust a company and instead allows you to trust the code. Finally, DeFi often offers better returns and lower fees. By cutting out the middlemen like banks and other financial institutions, DeFi protocols can pass the savings on to the users. For example, the interest you can earn by lending your crypto in a DeFi protocol is often much higher than what a traditional bank savings account offers. Similarly, fees for trading or transferring funds can be lower because there are fewer intermediaries taking a cut. This efficiency makes DeFi an attractive alternative for those looking to make their money work harder for them, creating more competitive and dynamic financial markets. Despite its many promises, the world of DeFi is filled with significant risks. One of the biggest dangers is smart contract bugs. The code that powers DeFi applications is written by humans, and well, humans can make mistakes. A flaw or vulnerability in a smart contract's code can be exploited by hackers, who might drain all the funds locked within it. We've seen quite a few high-profile hacks where millions of dollars were stolen in an instant because of a single coding error. While code audits can help, they're not a perfect guarantee of safety, making this a persistent threat in the space. Another serious concern is the prevalence of scams and fraudulent projects. The open and permissionless nature of DeFi means anyone can create a new token or application, including, unfortunately, malicious actors. Scams like rug pulls are common, where developers create a project, attract investment from users, and then suddenly disappear with all the money. Phishing attacks are also rampant, where scammers trick users into revealing their private keys or connecting their wallets to malicious websites. Navigating DeFi requires a great deal of caution and personal responsibility to avoid falling victim to these schemes. The high volatility of crypto assets adds another layer of risk. The value of cryptocurrencies can swing dramatically in a very short period. If you're using your crypto as collateral to take out a loan, a sudden price drop could cause your position to be liquidated. This means the system automatically sells your collateral to cover the loan, and you could lose all of your initial investment. This market volatility makes DeFi a much riskier environment than traditional finance, especially for beginners who may not fully understand the potential for massive and rapid losses. Finally, the user experience can be complex and unforgiving. Unlike a bank, there's no customer service hotline to call if you make a mistake. If you send your funds to the wrong address or lose your private keys, your money is likely gone forever. There's no central authority to reverse a transaction or recover your account. This high degree of personal responsibility can be daunting for newcomers. The current state of DeFi requires a certain level of technical knowledge, and a simple mistake can have costly consequences, which remains a major barrier to wider adoption.